One Up on Wall Street by Peter Lynch. Invest in things you understand. The best way to illustrate this is with a story about two friends. There's a doctor and an oil executive. So the doctor works hard. She spends her day diagnosing people and prescribing drugs. She understands the ethical drug business inside and out. But when she goes home, she watches the financial news channels, hears about an oil stock, and invests in that. Okay. On the other side, we have the oil executive. He also works hard. He knows the demand and supply figures for oil over the past 5 years. He knows which companies can survive at low oil prices and which cannot. He knows how shale oil is affecting oil prices. But when he goes home and looks at his portfolio, he decides to invest in a pharmaceutical drug company because it's a lot more sexy than the oil business. Now, what is wrong with this? Well, the oil exec is in a better position than the doctor to decide when to buy or sell, say, ExxonMobil. And the doctor is in a better position than the oil exec to know that some particular drug has been very successful and the pharmaceutical company that makes it may be a good investment. The doctor will be the last to learn of important changes in the oil executive's industry and vice versa. If a business makes a 16 terabit polysilicon 2 gigahertz device with synchronous capability and you have no idea of what that is, stay away from its stock. And if you do happen to understand that, then hey, by all means, dive right in. But the point is, there are a lot of products and services that you may use at home, at work, or at school. And some of them are made by companies whose stocks could be great investments. Those are great places to look for investment ideas. What you understand is going to be different for everyone, depending on your interests and experience. For example, growing up, I've loved the game FIFA. I'm actually borderline embarrassed when I think about the amount of time I've spent playing it. I've played the game since 1997 when it came out on the computer, all the way through to FIFA 2015 on the PlayStation 3. During that time, I've gotten a decent understanding of the game. I know the competing games, I can judge when the latest release has been decent and when it's been terrible. I know what consumers of the game want because I am one, and a lot of my friends and family are too. Basically, it's a product to understand. Well, if I'm looking for investment ideas, that's not a bad place to start because it's a company I can actually judge. Maybe there's an ice cream franchise that's really succeeding in your area and expanding well. Go check them out. We often don't think of going around eating ice cream or donuts as sophisticated stock research. But that's the point. You don't have to invest in things that are over your head to make money. Dunkin' Donuts' stock price rose by a factor of 25 from 1977 to 1986. Any customer of theirs at the time could have said, hey, these guys seem to be doing pretty well, let me check out the stock. Now, this doesn't mean that you should invest in a company just because it's your favorite restaurant or it makes your favorite product. It just means that those are great places to start looking. You still have to do your research after that. You should be able to give a 2-minute pitch of the stock, telling people why you're interested in it, what must happen for the company to do well, and what are the risks it faces. You can find great stock ideas in the neighborhood or at the workplace, when you're eating, when you're shopping. If a friend had a great stay at a hotel, check out its stock. Then follow up your research by actually using the hotel. Bounce on the beds, stick your toe in the pool, try their food. Over a lifetime of eating pizza or buying cars, you've probably developed a sense for these products that you'll never have with microprocessors and high technology. The second big idea from this book is that you do not want to try to time or forecast stock prices or focus on the economy. Instead, focus on finding great companies. One Up on Wall Street became a bestseller in 1990. That same year, another book called The Great Depression of 1990 became a bestseller as well. Now the point is, there is always a reason to be bearish on the economy and stocks. Always. The bearish argument often sounds very intelligent, but that's not what you should focus on, because in the end, it's about the companies you own, not the market that you are in. That's not to say that there's no such thing as an overvalued market or a recession, but there's just no point worrying about it. In the end, superior companies will succeed and mediocre companies will fail. Investors in each will be rewarded accordingly. Lynch doesn't believe in predicting markets. Instead, he focuses on buying great companies, especially those that are undervalued. So, how do you look for these companies? Lynch has 6 categories of stocks: slow growers, stalwarts, fast growers, asset plays, turnarounds, and cyclicals. The first 3 are categorized by how fast earnings are growing. The next 3 are basically different situations. An asset play is a company with valuable assets that are not fully recognized by other investors. A common example of this is a company with real estate that was bought a long time ago that's now worth a whole lot more than its financial statements show it to be, or than it was worth when it was bought. A turnaround is a struggling company that you believe will get back on track. Think one of the Rocky movies. A cyclical is a company whose earnings are cyclical. So car companies are good examples. They tend to sell a lot of cars when the economy is booming and people have money, and they struggle to sell cars when we're in a recession and people don't have a lot of disposable income. Using these 6 categories is a useful way to start developing the story on a stock that you are looking at. Lynch invests in the above categories, but what he really favors are small companies that are growing earnings quickly. Because if growth in earnings makes a company more valuable, then why bother with slow growers? He looks for companies growing quickly in industries that are not, because high growth industries attract a lot of competition. That makes it difficult for the company to succeed over the long term. Just think of all the brain power in Silicon Valley right now. It's difficult for a business to take that on and succeed consistently. Small companies in low growth industries also usually don't have a lot of analysts that are covering them. So you can find really attractive stocks available at great prices. It's a lot more difficult to have an edge in a big company that is widely followed. In 1990, IBM was covered by 56 brokerage analysts, Exxon by 44. It's tough, it's really tough to have new insights on a company that 56 other analysts don't have. Although it is still possible, but man, that's tough. Rather, look at the stock of that clothing company you love. You probably understand it much better, and it may just be small enough to be a fast grower that Wall Street doesn't follow for a long time to come.